The final quarter of 2025 looks set to provide a fitting climax to what has been a volatile year for markets, one that has forced allocators to look closely at their portfolios and reassess risk. Many of the themes that have dominated the year continue to occupy investors' minds: market concentration, the dollar, central bank policy, geopolitics, to name but a few. Happily, we have a range of Fidelity International experts on hand today to discuss how they're positioning for this final year's backdrop. I'm joined by Ilga Haubelt, Head of Equities, Henk-Jan Rikkerink, Global Head of Multi-Asset, Real Estate and Systematic, Salman Ahmed, Global Head of Macro and Strategic Asset Allocation, and dialing in from Hong Kong is Lei Zhu, Head of Asian Fixed Income. Thank you all for joining us today. Before we start, just a reminder that you can use the Q&A function to ask any questions you may have throughout the discussion, and we'll try to answer some of those at the end. Let's kick off with a macro backdrop. Salman, over to you.
Thank you very much, Carsten. So let me dig right into it. Let's start with the cyclical picture. What are our trackers telling us about the state of the US and European economy at the moment? And I'll discuss China a bit later. So if you look at our indicators, which we watch very regularly to get a sense of the cyclical momentum, we did have a very sharp fall during April, the Liberation Day volatility, but we did bounce back both in Europe and in US post that. And we are not seeing any renewed sign of a significant downturn in recent months, although the indicators remain subdued, and that has been more consistent with the ongoing slowing of the labor market in the US. But overall, there is no clear sign or any significant warning sign that we are facing an imminent recession, especially in the US economy. If we go to the next slide, let me show you on the labor market side. This has been, of course, in the US, a major talking point, of course, has been the major driver behind the pivot we saw from the Fed. Clear slowdown in payrolls data. We have seen, although there have been a lot of focus on what is the break-even rate of payrolls now that we also are suffering a supply-side shock, potential supply-side shock because of the immigration crackdown, and what is consistent with a target of 2% inflation. But clearly, if you also look at other indicators of labor market, especially job rates, quit rates, and hiring rates, we have been seeing a more consistent demand-side slowdown as much as a supply-side issue in the US labor market, which has been critical in driving the pivot from Chair Powell, despite that big politics, which I'm sure we would discuss, which is the Fed is facing right now. We go to the next slide. Let's dig deeper a little bit into Europe. Credit growth has been on an upward swing, helped by the ECB cuts. That has started to show a little bit in growth momentum, but did stall a little bit over the last couple of months. But again, there's no significant sign we are picking up that a growth momentum shock or negative growth momentum shock is in play for Europe either. And if I go to the next slide, a bit on China indicators, steady as she goes. This has been our strongest call this year, that controlled stabilization will come through in China, supported by policy, and the focus will shift onto the markets and where the valuations were quite depressed. But as long as far as macro is concerned, there has been very strong support by the policy through credit growth, which has been showing up in our indicators, which has shown no sign of any kind of significant deterioration. If anything, more or less stability in the property sector, which has been obviously a problem area for several years going into 2025. If I go to the next slide, let me show you a little bit on policy dynamics. Credit growth is the main game in China at the moment. Fiscal policy-driven support has been strong. Of course, China will continue to need that support. Of course, there is also rapprochement happening between US and China, potential for a trade deal, but that is not going to take us away from the US-China centered rivalry, which will play out for years to come. But certainly, the policy support is there, and we have seen that being targeted towards the domestic demand and consumption sector. If I go to the next slide, Let me just spend a little bit of time here in terms of the medium term. This is going to be very important. What does the world look like in 3 to 5 years' time? And this is something we are asking ourselves from a strategic asset allocation perspective. Our base case is fragmentation. Developments over the last few months have been consistent with that, which is that you will start to see very clearly blocks appearing when it comes to economics, technology, military. You have obviously very clear signs of a US block appearing, more and more signs of a China block appearing, and Europe is somewhere in the middle. But certainly the tail risk of a China isolation, whereby the Western bloc, puts very, very heavy tariff rates on China. The probabilities of that have reduced given the US-European relationship and the tensions there. Or on the other side, US isolation, I think that is also off the table, as we have seen. And the blanket tariffs, we moved out of that because it was so painful for all the countries involved. But fragmentation is clear, and that has been a key theme for us when we've been talking about diversification in asset markets context as well. If I go to the next slide, I will end here. Something we are focused a lot on, which is that, what happens next year when the new Fed chair comes into play? Will it be Stephen Moran or somebody else? What happens to the long end? We have seen steepening of the curve, which has been our focus area, depreciation of the dollar. What I want to remind you here is that US has used YCC before, which is yield curve control, during the 1940s and 50s. Very successfully, I would argue, given that debt ratios did come down quite significantly once the US went into YCC. It had impact on long bond yields. The short end, which is increasingly going to be affected by the new Fed chair, which is likely to be very, very dovish. But this is something, an area we are looking for, because this is not going to last for 1 quarter, 2 quarters. There is a clear sign of a regime shift happening, and this may last for years. So this is something we are focused on as we move towards 26 after this hopefully interesting quarter which lies ahead of us. With that, thank you very much, and let me hand the floor back to Carsten.
Thank you very much, Salman. And you have spoken about the Fed and Fed independence already. Now, has anything changed lately with Stephen Moran dissenting, of course, as the only one member with the current rate cut decision, and with possible new Fed chairs that they may will be announced at some point. But how do you see the independence of the Fed going forward? Is there any indication that this will be critical, and what does that change in terms of interest rate outlook, inflation outlook for the United States?
I think first thing, there are 2 points I want to make. Firstly, the data, and then I'll come to the Fed independence, because obviously data is the input. Firstly, I think there are a lot of concerns growing in terms of how much trustworthy the US data is. So me and my team are already looking at a lot of alternative data, trying to sense check what is going to be reported. These are early days, but this is a direction of travel. And I think that also feeds into the broader credibility of the Fed and how it deals with its 2 mandates. Of course, as you know, Stephen Moran has been talking about very clearly about the third leg of the mandate, which is targeting the debt market. And that's why we have been talking a lot about YCC. So I think next year, May onwards especially, the question for us would be how much of Fed policy reaction function shift will be towards the labor market rather than inflation. So we have been making progress in that direction for years now. And I think it is potentially going to get accelerated. For example, in our own CMAs, we have been penciling in 3% inflation for 10 years since 2022. And this is now, I think, in fact, the onus is now people who argue against it rather than us. So I think the independence discussion is going to become intense. What will matter is how dovish, fundamentally dovish the new Fed chair is, and what is their view in terms of structural changes to the Fed reaction function. I think the probability of that happening is pretty high.
And not only about that issue with Fed, but also with the tariffs. The Supreme Court has to make some rulings going forward. Do we have a preview on how that could go? And if the Supreme Court were to rule in the favor of the US government, how would that change our view towards the US?
I think this is probably going to be increasing that probability. Just to give you an example, last night, the FTC commissioner changes by the Trump administration has been validated by the Supreme Court. Obviously, Lisa Cook was allowed to sit in the September meeting, but we have seen a lot of rulings in the US come through partisan lines. And this is very likely that this will also come through on a partisan line basis. So a more broader interpretation of the executive power. And that what that means is that you will get to a fiscally dominated Fed faster than otherwise. And I think May 26 obviously is a critical date, but the board composition will look very, very different as well. And we are already in progress.
And maybe one other question on the US tariffs. We haven't really seen a huge impact yet of tariffs on inflation data and on others. Do you expect that to change going forward? Because I think the day of the implementation was beginning of August, so we haven't really seen a full month yet. And if so, how will that change the picture?
So already we are seeing some components of goods inflation which are more sensitive to tariffs starting to pick up. Chair Powell was also focused on that in his latest remarks. Now, the question is, it's pretty clear that effective rate of tariff in the US is not going to be below 16%. It's going to even grow. Yes, IEEPA is being challenged, but the US administration has many other options to substitute those tariffs. So Section 232, Section 301, and it's very likely that IEEPA will not be struck down by the Supreme Court. So we are looking at a world where tariffs are going towards, let's say, 19%, which is our base case. We think that will start to build up inflation. And please, let's not forget, this is the fourth year going where US has not hit, or Fed has not hit its inflation target, and they have cut rates. So this is going to become a more intense issue going forward as the shock builds up, because this is more rewiring. This was never a one-day shock. And it takes time. I think corporate behavior and other things will be at play. But this is something we are going to be watching very carefully. But I will also add, last point, is that we have to also question the data which comes out.
Yeah.
And that's why the alternative sources of data are going to be very important.
Thank you, Salman. Let's get to you, Ilga. And despite all this macro uncertainty, equity markets have been brilliant once again. We've had another very good year. So what to you is the main reason for this still very constructive equity market, and why hasn't it been derailed at least somewhat with these current macro risks?
You are absolutely right. It's fascinating. It's a very good question, Carsten. First of all, the market has obviously chosen to take a glass half full approach, right? To ignore some, even of the first round, tariff effects. And we've heard some companies coming back that the margin hit is not as bad as feared. And then we obviously, and I'm sure we'll later in the session touch on it, we've had, this tailwind from AI and AI capex that we've seen, but that's well known to the market, right? Mm-hmm. The story is much broader than that. We've seen a broadening out. We've seen Europe changing, especially Germany changing, to more fiscal support, to a growth agenda. We've seen in January with, the DeepSeek moment in China, huge tailwind from innovation. And even if you look into the earnings picture, even, within small caps, mid caps, and the larger caps, we've just seen a broadening out of the profit cycle. So the markets have been able so far to climb the wall of worry. So the question for us is, I think, what keeps us in this glass half full mode? And that's given that markets have been driven by multiple expansion across the globe, except for the US, where, the AI has helped in the tech sector to drive huge earnings growth. First of all, we need to see delivery of earnings. And second, we all know, momentum can last longer, and we don't see exuberant positioning. So there can still be some more optimism and tailwind driving these markets. Yeah.
The one thing that has changed, though, is that the US is now behind in terms of market performance versus the rest of the world. That's the first time since a long time, I think, that the US market is really running behind. So that has changed. Is there a reason for us to believe that this can continue? Is that also somewhat an explanation of these maybe tariff risks that are causing the US to stay back a little bit? Or how do you see geographic equity allocation going forward?
I mean, Carsten, if you remember, I think we have to go on a bit of a journey, right? If we were sitting here 12 months ago, everybody was talking about US exceptionalism, right? And then January hit the DeepSeek moment, where basically the tech and the innovation advantage that the US has got put into question. We then had, Liberation Day, and all of this has led to a rotation in the markets where investors moved money out of the US into Europe and then into China. But we've seen the US come back strongly post, the Liberation Day load, again driven by the AI tailwinds. And the way I would describe it is that we've seen somehow a stress test of the US exceptionalism, and that they've now proved profit exceptionalism. And then tying into what Salman has shared, what has changed is there are more questions around the institutional strength or the predictability. So investors have chosen to broaden their exposure. I've started, I've been a US portfolio manager in the past, so never bet against the US, was the rule, but there is for sure, because they have very strong backdrop. If you think about innovation, if you think about cheap energy, if you think about, deregulation that is going on, but there is, and we can see it in the flows as well, right? There is for sure an appetite, for investors to broaden their exposure.
Now that you've mentioned the flows, maybe one follow-up question here is, with the changes in returns this year and also the changes in the dollar, which we will talk about going forward as well, have we seen strong reallocation flows out of the US into Europe and Asia performance-wise? Yes, but is there really a lot of flows that we've really seen? And is that a continued thing? Because like from the summer, I think Europe has been rather quiet in that regard. So what can you tell us about the equity flows? Right?
I think rotation is really the flavor of the day this year, right? So we've seen the rotation, as we touched on in the first quarter, into Europe and China. And then, after the Liberation Day sell-off, we had a positioning in the US that was as low as we haven't seen since 2014 anymore. So some flows moved back into the US. But interestingly enough, in Q3, we have had a very interesting development, and we've seen very large inflows into global ex-US funds, more than 46 trillion, more than double of what we've seen in global funds that include the US, which plays into this theme of broadening. And I think what we need to dig one level deeper as well and think about, who are the market participants that are active in the market. And that has shifted over time as well, right? Retail has reached new highs. 25% of the flows we've looked into it for the US come from retail participants now, while hedge funds and long onlys have halved over the last 10 years. So basically, what you have is on the institutional side, I don't want to put all eggs into one basket. So this move into broadening out, and then a lot of excitement around AI in the retail space. And the retail investors are the marginal buyers that add fuel to this fire. So that's how I think about it, Carsten.
Thank you. At this point, I want to remind everyone, if you have a question, please, for the audience, please tell us, and then we'll ask the question. Now I get to you, Lei, another part of the risk asset market, especially credit markets. We have witnessed really now strong performance as well in credit markets, the lowest spreads in high yield and investment grade that we've seen over a long time right now. How are you looking at credit markets right now? Will this kind of positivity continue? And where would you allocate within credit markets at this point in fixed income?
Yeah, thank you, Carsten. So indeed, for Q3, so far, the credit market continued to perform well. If we look at it globally, so credit spreads across IG and high yield has tightened in the Q3. Alongside with the US Treasury rates actually also going down. So combined, total return has been quite impressive. Talking about investment grade, so across the board for Q3, it tightened about 10 to 15 basis point, being US IG, Euro IG, as well as Asia IG. So we do see, that the spread is very tight. So it's at a historical tight level. However, there is still pockets of opportunities in the space. So we do see values in the very high quality part of investment grade. in particular the medium term bonds, as we see investors continuing looking for diversified bet in addition into a U.S. Treasury. So single A, double A, triple A rated credits are well sought after in the market, while supply has been very limited because the corporates they take advantage of the ultra low interest rate environment previously and pre-fund their needs. So the supply is limited while the demand continue to come as investors are looking for diversification in the investment grade space, in particular for the very high grade quality paper. So we like actually short duration to medium duration, high quality IG papers. In addition to that, there's also rating migration opportunity. So there's a rising stars and there's a rating upgrade. Of course, there's a rating downgrade as well. So we see the sovereign space, for Q3 has been very active. So in Europe, we have France be downgraded, but Portugal be upgraded. And in Asia, we see more upgrades on the sovereign front. We have India be upgraded from BBB minus to BBB flat. And then we also on the high yield side, you have Pakistan also be upgraded. So that kind of sovereign rating migration also drive the spread, either move up or move down. So this is also given us bottom up opportunity. In terms of high yield, Asia high yield continue to be deliver very strong performance after 2-year recovery. So the spread is tightened almost 60 basis point in Q3, and that's continue to tighten. The valuation is still pretty attractive at about 400 plus spread, while versus its own historical tights around 150 still have room to go. Compared to US high yield and Euro high yield, the spread also tightened in Q3, while at a slower pace because of a relatively tighter spread now. But in general, high yield also offer a decent carry opportunity for investors in this kind of all in yield high environment, and high yield in general have a low duration. For instance, Asia has only 2 to 3 year duration. So they are less sensitive to the interest rate move in this environment. So we do see high yield continue to offer some carry opportunity. Of course, we need to be very name selective, but in general, in this or in yields or spread, it offers decent carry opportunities for investors, and the spread could continue to be tightened.
I want to look at the US dollar once again. We're looking at central bank moves. We're looking at Asia with the potential of lowering interest rates. The US is now on the path of at least lowering interest rates partly. So what's your view on the US dollar right now? It has depreciated quite dramatically over the year yet, and it has had big implications on some return figures, also in fixed income markets. What can you tell us about the path of the US dollar going forward?
Yeah, this is a very good question. In fact, US dollar depreciation is mostly happened in the Q2 after Liberation Day. In fact, in Q3 so far, the US dollar index being against G10 or is against EM or Asia has been flattish. But if you look, deep dive into the breakdown, the different currency have different performance. You have half of the currency appreciate against US dollar, and then you have the other half actually depreciate against US dollar. So on the net basis, the index looks like unchanged. So what we are seeing is the high quality currencies being have a very high sovereign rating and also trade surplus countries. They have a currency continue to appreciate against US dollar. What we are seeing is these countries, the past, they have been recycling their investment in the US dollar market, being equity market or bond market. But increasingly, they are actually not adding additional exposure to those market in US dollar market, but they are converting back to their own market. So that drive the appreciation of their own currency and also support the overall local currency bond market, in particular, the high quality local currency bond market. So we are saying this is an alternative safe haven currency, which is very limited in the world. While on the other hand, we do see the market also see some cracks in other economies. So we have some volatility in some emerging markets. So we are not saying, okay, it's a broadly rally of a non-dollar currency to dollar. Now it's also down to the fundamental of those economies. And we do see, for example, in Asia, the currency have quite resilient, and the central banks continue to cut interest rate, in fact, to slower the currency appreciation versus the dollar to support the overall economy and to offset of some of the tariff effect, as well as to provide more liquidity into the market in case there's a further shock from the tariff side.
Before I come to you, Henk-Jan, I'm sorry, I have to get one follow-up question on the dollar, because we talked about it for Salman. We talked about yield curve control. You talked about it in the last slide. And so the question from the audience was, can you mention the prospect of yield curve control? Do you really think it's going to happen? When will it start, according to your view? And how will it change with regards to the Treasury in terms of issuance, like on the short end and the long end? And maybe, and that's a question for you, maybe then how we position in treasuries, but maybe that's a good question to start with.
Sure. So I think yield curve control, obviously the way it was done in the 1940s and 50s was a very, overt yield curve control. But there is a spectrum here from 0 to 1, right? And the issuance structure changes, which are already in play, I would argue are quasi yield curve control, which is basically Scott Bessent focusing on the short end whilst you are getting a friendlier Fed in the pipeline. So that moves the interest rate costs down. But at the same time, in terms of an overt yield curve control, I think an episodic issue in the US. So if you have a run on the long bond, long end, that may push the Fed come in the garb of financial stability, like we saw with BOE back in the day. But that may stay, so it may have staying power. So episodically, I think we have to be careful about it. But I think the trend is towards that a government which doesn't want to issue a lot on the long end, and that has implications of the dollar. So that's why we have been holding this view since March that we are likely to see a multi-year downward trend from an SAA perspective in the dollar, and that's why we have been focused a lot on strategic asset allocation and strategic hedging of dollars from a non-USD based investor basis.
Now, coming to you, Henk-Jan, and an overall view maybe to get all that together and talk about tactical asset allocation. So what are our latest views in terms of tactical asset allocation? How has our views changed with regards to the backdrop that we've just heard about? And what do we think about diversification at this point?
Yeah, no, great question. It's been interesting to listen to my colleagues, because these are all the issues, obviously, that the multi-asset team thinks about as well. So our multi-asset investment team has been relatively neutral on risk for the first half of the year, given both the uncertainties and we felt the balance of risks and the possibilities of tail risks. More recently, we felt the environment has changed. So we're now explicitly overweight risk. We're risk on for equities. We've remained underweight credit, and we're neutral on duration. We don't have hugely strong views there. Unpacking that a little bit, maybe let me focus on the risk-on part of it. So I'll do fundamentals, valuation, technicals. That's how we like to approach it. So from a fundamentals perspective, very much building on what Salman said, growth in the US is better than we expected 3 or 6 months ago. There were quite a few concerns out there. It has come through. And clearly US policy is to drive nominal growth GDP and to drive financing rates down. Peak inflation risk appears like it's behind us. Yes, we'll continue to get a little bit of a rise in inflation from the tariffs, but rising inflation is not too bad. Generally, is good for nominal growth, and nominal growth generally is good for equities. Central banks around the world are accommodative. I think we've had something like, someone might correct me, something like 100 central bank cuts this year. We've only got one central bank rising. So monetary policy is supportive of equities. Fiscal policy, look, we have large deficits everywhere. No huge extra impulses per se, except Europe, but that's fine. And earnings fundamentals, as we heard from Ilga, are solid, right? Q2 was a solid earnings season. Earnings revisions are positive. So there's lots of reasons to put fundamentals on a pretty good track. Moving to valuations, of course, the longer held concern that large cap equities are richly valued is still true, but earnings are resilient. And as long as earnings stay resilient, we think that's not a reason to go underweight equities. And there's certainly opportunities for re-rating outside of the US. And we have a preference for emerging market equities over developed markets. And then finally, on technicals, again, Ilga mentioned parts of that as well. Most of our models now on the technical side are risk on. The earnings seasonality headwind is behind us. Breadth is improving. We have had a little bit of an everything rally since we had this conversation a quarter ago, which is a little scary because everything's gone up. But we do think overall it's got a little bit more to run. And as I said, underweight credit, we think IG spreads are a little bit too tight, so we prefer high yield and emerging market debt. And on the government bond sides, we have a preference for EM there as well. So that's where we are overall.
Last time we didn't talk about a lot about private markets, which I would love to do right now, because we're observing a difficult funding environment for private markets and other challenges that are happening right now. So what is our view on private assets and where do we see opportunities at this point to increase the diversification of an overall allocation?
It's a great question. And let me maybe talk first a little bit about the environment in general, because it is quite different from the conversation we've just had on the liquid side. And then I'll talk a little bit about where our team is finding opportunities. Maybe for context to our viewers, we have a team of private asset allocators that look across all the asset classes all over the world to find the best opportunities for clients. In terms of the key themes in the marketplace, fundraising has been hard, right? And in many asset classes, private equity is a real standout. It's been hard to raise money, and where money is being raised is going to the mega fund. So mega funds is much, much more concentrated than it was before. On the flip side, deployment has become more selective. There's something like $4 trillion worth of dry powder sitting there, waiting for a bit more clarity on valuation, on rates. So there's a lot of money potentially looking for deals. That said, some of the longer term trends, Ilga mentioned AI, energy transition, digital infrastructure, I'd mention as well. The longer term trends, deal flow there is fine and activity is fine. There has been, interestingly, quite a valuation bifurcation in private assets recently. So private assets obviously have typically a lower reported volatility. But if you go underneath that, we haven't really seen the public market rebound back into private assets so much. So high quality growth assets are valued well. Cyclical or levered assets, much, much less so. And I think we all know as well that there have been liquidity constraints, right? Exits are hard, IPOs are hard. So that creates secondaries, continuity funds, etc. So what's the opposite here? Where are we seeing opportunities? I'd start with private credit. It remains attractive. Parts of direct lending in the US are becoming commoditized. You have to be very specific where you go, but that remains attractive. Secondaries are booming, but GPs and LPs are both actively looking at this space, but you've got to make sure you pick high quality assets. There are some out there that are liquid because GPs want liquidity. In private equity, it's really important to be selective, especially in the large cap space. We have a preference right now for more buy and build in the mid-cap space. And in Europe in particular, there's some very good special situations out there where there's companies in trouble, maybe struggling with refinancing. You can pick up some good valuations. So maybe in summary, the easy 10 or 20 years of everything in private assets going up is behind us. It's harder. You've got to be more selective in which sub-asset class to choose, and you've got to be very selective on which managers or which assets you invest in.
You mentioned European mid-caps. Now I want to come back to you, Ilga, because that is obviously something digging deeper a little bit into the big small cap area. In the US, large caps have been the one and only thing. Mid and small caps have not been running well. Valuation differentials are big. In Europe and Asia, we've seen different tilts, more towards the mid and small cap end, and people are asking, is this the time now to build up this part of the portfolio? So how do we see the big and small cap kind of development going forward? Who's benefiting in what regions, and how are we positioned there?
I think, Carsten, let's start at understanding where, what is driving these differences, because that gives us an idea, going forward and where we might find attractive opportunities. As you mentioned, a lot in the, I would split it into sector, policy driven, market structure driven reasons, and then we can look into the fundamentals. I mean, if you think about the US market structure, a lot of the large caps is tech, it's cash flow rich. The smaller caps have higher leverage. Very often we have unprofitable business models listed in the US, and this has led, to the drag and discount. A lot of the smaller mid-cap companies will have to come to refinance at the beginning of next year because the COVID finance is running out. So there are headwinds for the sector. On the tailwind side, it's not all bad. There is some, silver lining. There is a lot of potential, and we've seen deregulation starting. And the small and mid caps, saw most of the burden from regulation. And last not least, they really matter. 82% of the workforce in the US works for smaller and mid caps. So we might see some, easing of that, but people need to be really selective and watch out for the financing part. You mentioned Europe and, other regions being, more attractive in terms of small and mid caps. Again, it comes back to the market structure, right? In Europe, the market is the larger caps are multinationals, it's pharma, it's luxury, we don't have that much technology, but the mid and smaller caps, they are in the sectors, that now see a lot of positive momentum from the agenda turning more into growth. You can tell from my accent, I'm from Germany, right? We have the Mittelstand there, and we have a lot of hidden champions in Europe, and this is, I think, where the value lies, and where we see still a lot of tailwind from a fundamental point of view. So this explains the differences and the different regional views on small and mid caps.
Can I maybe jump in there?
Of course.
Interesting hearing you speak. So we've spent a lot of time thinking about the different countries in Europe, and we quite like German mid caps at the moment. There's obviously a tailwind coming from the fiscal stimulus that is going to be very significant over the coming years. But the German mid cap is very, very closely associated and correlated to the industrial sector. And the industrial sector obviously has been in a recession for quite some time. I don't need to tell you this, Carsten, you've flown over from Germany for this event. But this coming out of that recession. And therefore the fundamental backdrop and therefore the earnings outlook for German mid caps, we believe is very strong, both on a relative to German large cap basis, but also relative to Europe overall. So that's a place, we're not stock pickers, we buy baskets, but we think there's good risk reward there.
And if you look into CapEx, right, it's utilities, it's energies, it's industrial. So you see the big blocks of CapEx. So you see, the tailwind from a top-down point of view. And we have the whole corporate CapEx cycle has shifted, right? Yeah.
So some green shoots developing in Europe, absolutely acknowledged. Ilga, you talked about market composition, and therefore we have to talk about the tech sector in the US that has driven the, AI rally significantly over the last few years. We've just made a Silicon Valley trip to get some, feedback from the ground. How are we, in the development and in the evolution of AI? Are we coming towards an end of the first wave now? And what's our view from the ground? How technology is driving the market going forward?
It's amazing. I think it was the 12th Silicon Valley trip that our team has done. And by the way, other parts of the team have just come back end of August from an industrials trip, which obviously is the other side of the coin, the AI CapEx side. I mean, there is excitement on the ground, right? AI still has a lot of momentum. But, what we do as fundamental bottom-up stock pickers is, first of all, we try to pick up the vibes on the ground, like you say. And the idea was really to say, okay, what do we see? AI CapEx still has a lot of momentum, but adoption is lagging. Yes, there are some exciting business cases where, for example, in call centers, you can replace 70 to 90% of the workforce by these AI agents. But the team has come back and said in a lot of other businesses, we still see companies struggling to really adjust processes and stuff like that. So in the consumer space, we've seen fast adoption. It will take longer on the corporate space. The second thing, what we try to do is really to find the underappreciated opportunities, because the market rally in AI has been very, very narrow. So they looked, for example, into software companies that have a very sticky customer base and can monetize AI, or thinking about the second wave you just mentioned, have we come to an end of the first wave, hardware, semi companies that can benefit from that. And then the industrials team, the team from the industrials trip came back and said, look, I know people are worried about data center equipment, but the momentum is very strong. And, for people that don't want to play, the first wave of AI, that's a good, that's a good place to find exposure. And we all know, and you've been around for a long time in the markets as well, it's hard to call the top, right? So looking for the places where you don't have the throw for it, but still participate, I think is a good strategy.
But AI and technology is also making the move into Asian markets, and we've seen some pickup in some markets. Korea has been moving really well. Hong Kong, the market has been really well. So, Lei, I want to ask you once again on the ground, basically in Asia, because China is the big elephant in the room, so to speak, right there. How do you see economic developments right now, and the recovery that Salman was talking about, the recovery in real estate, the so-called longer-term stabilization? How is that playing out, at home for you?
Yeah, definitely. I mean, China is definitely the focus in the market. So what we are seeing is the recovery. I mean, if you look at the consumption sector, so it's very divided, right? So we do see some recovery in the service sector, while like travel or all these, service-oriented industry. However, on the consumption side, I mean, the consumer is pretty still constrained by the lower the continuous property price correction, as well as unemployment rate is still stay high for the youth sector, as well as because of the factory shift overseas. So that definitely hurt the consumption sentiment on that front. On the property sector, so it's a focus of discussion all the time. So what we are seeing on the ground is, I think the market is bottoming, but we haven't, see signs of stabilizing according to the data. So there is a signs of stabilize in terms of the price for the very high end segment for the first tier city, while for the others, I mean, mass market, the prices can still continue to find the bottom, although, I mean, the pace has been slowing down. So, I mean, we talked previously, this is the bubble definitely burst. So we are in the process of restructuring the sector, so which will take multiple years. We are 4 years in from the bubble bust from the peak. So it could be another 1-2 years bottoming. So before that property sector see meaningful pickup, it's hard to see the stabilize. I mean, to support the consumption sector massive pickup. I mean, equity market is also a topic on the ground. I mean, everyone see the strong rally in the China equity market. So on the ground, I mean, the feedback is probably that this time the participation from retail is still limited. So the retail, I mean, we probably still have room to go with the retail continue to come in. So if retailers are making more money from it, it will help to stabilize the consumption sector, and then it's a positive wealth effect on that. On the policy front, we continue to hear PBOC governors saying, I mean, the policy, it will be data dependent. If you look at the data itself, the CPI is still remain quite low, and for the other PMI, etc. So they do see signs of improvement, but we expect, I mean, the markets continue to expect more monetary easing is down the road. They do have a room to cut interest rate given still quite high real rate. And they want to save the bullets for potential, I mean, what they see from the trade negotiation or any shock in the market. I think the central bank is standby. So that's a good sign. At least they have bullets to deploy. I mean, if there's to help to overall support the economy as well as to stabilize the property sector.
I have just got a question coming in for Ilga once again about market breadth in the US. You said before, never bet against the US. But on the other hand, the market concentration is as high as ever, I think, with regards to the top 10 and top 5 stocks in the index. Do you see that as a risk, and, that let's say valuations or the breadth, that less and less stocks are supporting the market side, and that could be a risk going forward?
Absolutely. And it's the third year in a row, right?
Yeah.
And we know there are some echoes, from other, call it bubbles or frenzies in the market. So third year in the row, really narrow leadership in the US, and that is a concern. But on the other hand, Salman talked about it, right? We've just seen the Fed easing cycle start, so we have for now a positive. We see growth slow but not collapse, right? We have a positive macro backdrop. And then we've talked about earnings broadening out, right? So this story can play out in two ways. We might, evolve from this spotlight on the couple of AI names to a broadening out in the market, which would be a healthier and balanced way of resolving the problem. And we are still not where we were in other cycles in terms of the beta rally of the stocks, and not at peak valuations. But I guess we are running out of time.
Last question goes for Henk-Jan, because the best asset class so far has been gold. And it's had a spectacular performance over the last few years, even outperformed the S&P and so on. So how do we think about gold, and how do we think about correlations to other asset classes in that regard?
Yeah, and so maybe two quick words. So we still like gold is the answer. From a correlations perspective, as per some of the things that Salman said, we do believe equity and fixed income will stay more correlated for quite a long time, because we're staying in an environment with higher inflation than we've had before. So a simple 60-40 diversification doesn't do it. Commodities have a role to play in that as an inflation hedge. And gold in particular, yes, it's expensive, but it's not yet the most crowded play, and quite a lot of our portfolio managers have a small allocation to gold. In an overall portfolio, we still think it makes sense.
And that's all we have time for. Thank you to our panel and to you all for joining today. A recording of this discussion and a summary will be available on your local Fidelity website over the coming days. Please do reach out to your local representatives if you have any additional questions. Before we go, just one final request to please fill in the short feedback form, which should pop up once the webinar ends. Your comments and feedback are hugely welcome. Thanks again for watching. From all of us at Fidelity, goodbye.